Right, this is being recorded. One thing I mentioned at the beginning of all these, if you're new to options or this particular strategy, because this may seem like very intuitive, it's a strategy everybody talks about. You can find it here on the web, anywhere else, but I have some specific rules that I talk about with this butterfly. So make sure that you understand it, follow those rules, because that will increase your probabilities of success. So take that and rewatch it, because the second time through it's really going to make these nuances stick. Anyway, this is going to be the option workshop on a long butterfly. If you remember, the last couple of weeks we've done the short butterfly. Now we're going on to the long butterfly, and then down the road here we're going to be doing broken wing butterflies. So keep your eyes out for that as well, because that's actually one of my favorite strategies too. So anyway, my name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Wall Street Journal, for my geopolitical, economic, and market analysis. I've been trading my own money since college. I actually started trading in college in my sophomore year with a psychology degree. I had earned some money and decided, you know what, I want to start putting this money to work, and started doing that. And decided in my sophomore year I was going to switch it over to finance. So kind of did an about face and got a finance degree after graduating college, moved to Chicago to work at the Board of Trade to follow that whole trading aspect and, you know, learn from the best. One thing I did say on the floor was that my psychology degree probably did more for me as a trader on the floor than even my financial background. But that is what it is. It's learning to stay mechanical. Anyway, in that time I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in all market conditions. We've got to go over this disclaimer really quick. Basically says any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and associate companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, what this really is telling you guys is I can't possibly come out and tell you guys what is a good stock to buy, what is a good strategy to throw in your portfolio, because I don't know what's in your portfolio already. It could, you know, throw that balance off and everything else. So at the end of the day, we're here to teach you these different strategies, and it's up to you guys to implement them into your portfolio suitable to your risk tolerance and your portfolio. So just keep in mind, we're here to teach you how to swim, not really to swim for you. And the bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. One other thing is, you can follow us on Twitter. You can follow me personally at Wolfman's blog, and you can follow Pro Trading Strategies at ProTrader Strat on Twitter. So you can get a lot of good information out there. This is earnings season, so I have a tendency to throw out my earnings trades at the end of the day, since they won't really make it into my daily market commentary, because it is basically I do the daily market commentaries early in the morning. It doesn't really make sense to put on an earnings trade early in the day, because you get the market to move and stuff like that. So I'm kind of throwing that stuff out there then, but you can follow us on Twitter there. All right, so this is the long call butterfly. Next week we're going to be doing the long put butterfly, but this is the long call butterfly. This isn't necessarily one of my favorite strategies, but at the end of the day, there's different scenarios for different strategies, and everything has its own rules. So at the end of the day, it's good to know all of these different strategies and when to put them into your portfolio. So unfortunately, right now, it's very difficult to find ones that will fit all the rules for the long call butterfly that I have, just because we have historically low volatility, and with that historic low volatility, it makes it difficult to find really good opportunities with this one right now. But when volatility is really high, this is a great one to put on. Anyway, the market assumption with this is that the market movement is going to stay inside the wings. So what we want to have happen is have this underlying start to generate a lot of high implied volatility around it, and then kind of settle down into a range. So I'm going to show you different things that I look for to implement this strategy when the timing is right, a little bit down the road, especially when we pull up the trading platform. But we are going to do that when we pull up the platform. But we want this to kind of settle down and settle into a trading range. How do we build this thing out? Well, basically what it is it's a long call spread and a short call spread jammed together. And you know, the long call spread is buying one call that's in the money and selling one that's out of the money or at the money, or as close to at the money as we can get, and then selling another short at the money call and buying one further out of the money call to define that risk. The difference between these two legs are going to be equal distance apart. So in a sense, when you jam it all together, you get one long in the money call, two short at the money calls, and then one long out of the money call. Again, equal distance apart. If we were talking about a $50 stock or something that was trading at $50, then we would probably be buying the 47 calls that are in the money, selling the 250 calls, and then buying the 53 calls in a sense. Now, how do we set this up, or how do we find the right environment for this? This particular one, the keys to success are picking the right underlying. That means we're going to be using the options that have a lot of open interest and a lot of volume in there. So we're not going to be picking the ones that maybe everybody's heard about, a stock that everybody's heard about, but just doesn't have that options participation. One thing I say with this tight bid ask is any stock that's trading under $100, we're looking for a tight bid ask of 10 cents or tighter. So we don't want to be trading a stock that's like a $30 stock and it's got a 25-cent wide bid ask. That just will eat your yield up immensely, and especially if things start getting busy or volatile, people are going to run away from that stock and go to the ones that have that open interest, and those bid asks are going to get much, much wider. Yes, Bob's asking, this is being recorded, so you'll get this sent to you as soon as I basically convert this recording. It takes about an hour, and then we send that out. What made me go to Chicago instead of New York? It was straight up I-65, 3 hours. Actually, a friend of mine that I was in college with, we were sitting down at the bar. I was getting ready to graduate, and he'd just come back from doing an internship in Chicago and said, "Hey, Eric, you have got to go work on the board of trade." He was like, "It's just right up your alley. You got to go up there, talk to this guy." And basically I walked around the floor and just started handing out my resume to people and started out as a runner. Did some trading through my brokerage firm for a little while, and then bought my badge, jumped in the pits, and started trading. Is this considered selling or buying strategy? It's considered a long call butterfly because you're basically doing it as a debit for the most part. So that's why it's considered a long call butterfly in a sense, and you're you're buying those wings. So does that make sense? All right. Then picking the right strikes with this one, what we're trying to do is, with a higher implied volatility, it allows you to get those wings, the two calls that we're going to be selling. The two calls that we're going to be selling are going to have a little bit more extrinsic value in them, and it's going to pump up those premiums. So it allows us to get those wings a little bit further apart. So that's the beauty in this. So that's why we want to be able to, because volatility is going to affect those near term or those at the monies more so. So we want that inflated volume so we can get those wings further apart. One of the other things is you know, for a stock that is like $50 or something, right around $50, we're going to be looking at trying to get, you know, $2.50 or like $3 wide on these. So try and get them as wide as you can. The higher the volatility, the further you can get those wings apart, and that is the best case scenario. All right, so and then picking the right durations. With this one, you know, I usually kind of look with most strategies around 45 days to expiration. This one, we kind of want it to be less than 35 days. So that's another reason why we kind of set this up around this time, is because we're right in that less than 35 days to expiration. The reason why is it's a very low probability strategy, so we don't want to have a lot of time for this stock to move outside of our wings. We kind of want to get in and get out of this one as fast as we can. So we kind of want to pick a shorter duration, not necessarily going into the weeklies to get that shorter duration unless there is a lot of participation in there, but something less than 35 days to expiration, because we want to take advantage of this theta decay. And if we can get that to happen rather quickly, it's going to increase our chances. We want to get that extrinsic value to kind of decay for us. And then we also need to know our exit strategy before entering this trade. One of the things I look at is if we're looking at, say, a $2.50 wide spread, we're going to be trying to get this thing down $2.50 to $3 wide. We're going to be trying to get this strategy and pay as little as we possibly can. So it's a low probability strategy. So we want to take about one of two things depending on your risk parameters. One idea is to take 2 times that debit paid. So if we're paying like 70 cents for a $2.50 wide strategy, meaning the in the money call and the at the money call are $2.50 apart. If we can pay like somewhere around 70 cents, that would be awesome. That means, you know, our max profit on that is over $2, but we're not going to be looking to take that. It takes a long time for these butterflies to achieve that max profit. It also, the longer you're in this trade, the probabilities are that it's not going to work out. So I kind of look at, if I'm paying about 70 cents, double that, you know, and if it's basically paying 50% the width of that, which would be like about $1.25, then I'm only going to be trying to get about 25% of that max profit, which is another $1.25, right? So we're going to be looking at really trying to get around 70 cents still. So the math usually works out, but the more I pay for it, if I'm paying close to 50% the width of those strikes, then I kind of look at it as taking 25% of my max profit potential. And then if I'm paying not very much for it, then I'm kind of looking to just double what I paid for that. Does that make sense for everybody? I know that may seem a little confusing. I think when we get into the platform, it'll make a little more sense because I can show you all how that all works out. All right, so our max loss on this is the premium paid. That's why I don't want to pay very much for this strategy, right? That's why I'm talking about like a $2.50 wide strategy. The last thing you want to be doing is paying over 50%, because then you're risking more than you're able to make with a very low probability of success anyway. So you're really lowering your probabilities of success when you pay a lot for this strategy. So the idea is to pay not very much, or less than 50% the width of those strikes. In that regard, if it's $2.50, we want to definitely be paying less than $1.25. So I'd even like to be paying much less than that, and I'll show you some examples that we can do that. When you have a higher volatility, you'll be able to do that. The higher the volatility, the less you end up having to pay for this strategy. But at the end of the day, it's a debit spread. It's IRA compatible. It will always be, anytime you pay a debit for anything, that's your max loss. In terms of max loss, when the trade moves against you, do you wait until expiration and take the full loss, or do you cut your losses with some of the capital, or do you defend this? Well, with this one, it's a great question. This one is very difficult to defend. The reason why is because of those longs that you're buying, and it's just going to decrease you're going to increase what you paid for this if you have to move those wings. So at the end of the day, I look at it with this butterfly in most defined strategies that I'm going to take that max loss on this. That's another reason why I kind of look to pay very little for it, because I went with a low probability trade to pay very little, because you're likely not going to have many of these work out. The ones that do will offset that, but at the end of the day, I put this strategy on, and if it doesn't work out, it usually doesn't work out right away, and it'll start moving outside those wings. That's, at that point, it's kind of like, I've seen it a lot of times where I've just let these go and it's gone outside of it, but it comes right back down close to the end of the trading of that option series, and it ends up working out. So usually I just let those probabilities kind of play out, and with this one, that is key for success. So you put it on, just keep your eye on the ball, try and take that percent of max profit, and if it immediately doesn't work out and moves away, I just kind of let it go and wait for it to come back in. And as soon as it does, then I really don't care what my profit is on it. I'm just going to look to kind of close that out, even if it's for a scratch. Does that answer your question, Luke? Usually we'll keep this on because anytime I pay for a strategy, it's very difficult to defend, and I know what my risk was going into it. All right, and your max profit is going to be that, you know, you can look at it two ways. I usually look at it the difference between the in the money call and the at the money call, because our wings are all the same across the board, right? Between the at the money and the out of the money too. So, but the in the money call and the at the money, the difference there minus that premium paid. So in the example I was kind of using as the worst case scenario for building out this strategy would be a $2.50 wide in the money to the at the monies, being the 47.5 calls and the 50 calls, right, that I gave an example about. The difference there is $2.50. Now, worst case scenario, if I paid a premium of $1.25, which is the very most I would ever pay for one of these strategies, then the max profit is $1.25. So you're risking one to make one in that sense. But I would never risk more than I'm able to make in this particular strategy because it is low probability. All right, so you're going to have two break-evens also, because you're going to have two wings, right? And one of the break-evens is the out-of-the-money call minus that premium paid. So in my example, with the 50 or the 47.5, 50, 52.5 call butterfly, you take those 52.5 calls minus the premium paid. In our example is $1.25. Your break-even is going to be $46.25. And on the bottom side, you basically take your in-the-money call plus that premium paid, which is the 47.5 calls plus the $1.25 is, what is that, 48.75? I'm having a brain cramp right now. 48.75 to the upside there. All right, so this is an older example, but this is kind of what it looks like on the Analyze tab. So what we obviously want to do is risk. This is our risk to the downside less than what we have the potential to make. And usually best case scenario is you're risking one to make two in this example. So it's actually risking one to make three. So that's why I left this up here. This is like one of the best setups you could ever have. You're risking $60 to make, or yeah, you're risking $60 here to make that $1.90 in a cent, or yeah, $1.90. So that is a great setup. That's why you want to pay a lot less. Probabilities are low, but the risk-reward trade-off is really good. All right, so let me get into the platform here, and this is usually like where I throw it out to you guys. Let's look at some different stocks that you guys like. John is all over it. I thought that you were asking for, you were already throwing out a stock, but we communicate back and forth on the questions area here. So throw out the stocks you guys want me to look at, and we'll pull up the platform and try and get a few of these going. All right. And JP Moore, okay, so let's go, we'll start from the top here. So I thought John was asking for that particular one. So Facebook, I think Facebook has earnings. That's another thing, you guys. We really don't want to do this strategy, although we are looking for high implied volatility. We don't want to do this strategy when we have the earnings coming up, and I think Facebook has earnings coming up relatively soon here too, don't they? And look at it here. And it looks like it has. So Facebook actually, Google just had theirs, so I have a different one. When is Facebook's earnings? It's on the 1st, so it's next week. So I probably wouldn't implement this one around. I like using strangles and iron condors around earnings. If you guys watch the daily market commentaries, I've been throwing those out there, or if you follow me on Twitter. So I probably would pass this because their earnings are on February 2nd, so, or is it February 1st? I think it's February 1st. So this strategy we would be putting on for that earnings, and what's the likelihood that it's not going to move at all for an earnings? That's what we really wouldn't want to build this around that. So it does have the high implied volatility. This strategy we want to implement in high implied volatility percent, which is above 50, or an ETF above 30. So if we find an ETF above 30, that would work because it's a basket of stocks and has a tendency to kind of smooth out its own volatility there. So a basket, ETF, or something along that lines, we can do above 30. Anything that's an individual underlying, we want to look at something above 50. And as you can tell by my screen over here, there are not very many stocks without earnings that are above 50. So for purposes, as a matter of fact, one of mine dropped off. This one was a little bit higher. It was like 49 starting earlier today when I was kind of looking at it. So I was thinking we would be able to do Qualcomm. We might have to do a couple of them just for sake of building this out that aren't necessarily going to look very well. So like we look at JP Morgan, I'm sure the banks have all had their earnings, and they have super low implied volatility. So JP Morgan, we can look at it on the thing here and see what its implied volatility is right now. But having said 6, so we want something above 50 for perfect scenario. But this is what I was talking about with the montage. You can see there's a lot of open interest here, a lot of participation in all of these. That has a tendency to bring in the bid ask. So something that's like an $86 stock, 4 cents wide is really good. So that would fit those rules. Even these ones that are going deeper in the money are still really tight and have a lot of participation. So that's what we want to have for something like that. The IV is very low in most cases these days. Will this be a problem? This is a problem for this particular strategy in the environment that we are in. There are a couple of them. Like I was looking at Qualcomm earlier today, and its IV percent was 49-ish, right around there. So I threw that one out there as one of my ideas. The other one is GDXJ, which is the junior gold miners, is an ETF that has something that fits the rule, and that's above 30. So we can go ahead and look at those. So for instance, let's look at GDXJ first. So with GDXJ, let's look at the chart on it. And this is one of the things I like to, I mean, I don't always use the Fibonacci's, but I know that a lot of people like to use them, and it has a tendency to come to fruition in it. Although we aren't able to take advantage of all of this, this would have been the perfect time to put this strategy on right here. As a matter of fact, you have high implied volatility. It gets, you can see it's kind of stuck between two Fibonacci levels. And the other key is this is where the most time and volume has been spent. So that, in a sense, is its happy place. It's where people are very comfortable. You know, anytime a lot of people have exchanged, buying and selling, and it's right there, those people aren't really making money or losing money. So they're not looking to cover it. They're not looking to panic or anything like that. So this is a situation where it looks like it's kind of settling down. So it has that implied volatility percent that's above 30, so we can take a look at it. The closest to the at the monies are probably these 37s. Earlier today I was looking at the 36.5s, but we'll look at the 37s. So with this strategy, what do we want to do? We want to create those two spreads, right? And we want to start out with selling the two at the monies. Now you can set this up by going up here to the drop down menu and set it up as a butterfly. I don't usually like to do it because I like to play around with the strikes. So I always build everything out the way as we go. So we're going to want to sell these two 37s. So we'd sell 37, hold down control, hit it again. That allows it to double up. And then I talked about going about $2.50 wide on this. So I might even look at going $3 wide, just because then I get the full dollar value. So let's look at the 34s. So the 34s I'm going to want to buy there, and then 3 to the upside to make it equal distance on both sides are the 40s here. So we're going to want to buy those to define our risk. So it's a defined risk strategy. So this is what I was talking about. If it moves up in a way that you're going to increase, if I have to get out of the puts and try and roll them up or whatever, all you're doing is paying more for this strategy. So it makes it a little bit more difficult. And if it moves way down, I suppose you could, if it moved way down outside the wings, I suppose you could buy back these 37 calls and roll them down closer to the 34s or something like that. But at the end of the day, it's defined risk, so I don't usually play around with that too much. But that might be viable to collect a little bit more credit and decrease your risk that way, but I usually don't. Why at the money? Why at the money? Because the at the monies are the ones that we're going to be able to collect the most for this. If you were a little slightly directional, let's say, maybe I was slightly bearish to this, thinking it was going to move down, you could move down a little bit, but again, then you're putting yourself at risk on your wings. So the idea is to try and hit it right in the middle here. And with this one, you can see we're kind of trading pretty close to a tight range here. So I would probably, at the end of the day, we're picking right in that middle of that movement. The other thing is with this strategy, because we're able to get up here, you know, we're above that Fibonacci level, which is going to act as resistance, and then we're well below this Fibonacci level to the downside, or right at that Fibonacci level to the downside, which will act as support, and it's going to, you know, be very happy in this area. So I could easily see it trending sideways, or if it happened to break above one of these or below, it's going to have a tendency to migrate back to the point of control. That's the idea, or the psychology behind this bell curve, is that even though it breaks up and away, it's going to have a tendency to want to migrate back here. If I were to, I've never rolled, so the question is, if you roll down to the 34, do you roll below or above the 34? With this one, I don't roll it. I wouldn't roll to that 34 because you're already long those 34s. I would roll if I were going to do it, and I've never tested this to see how much this will work out or how often it does. But, you know, I probably rolled to the 35 to collect a little bit more premium. And if you could reduce what you paid for it altogether, you know, if you were able to do this strategy, let's say for 70 cents and able to collect another 70 cents, so now you don't really have any risk on the table, then that might actually work out. Or 89 cents. I don't know if that's going to be possible though. I've just never really tested that part of the theory out. I just usually let it go and let it play out, because it's defined, and that's what I do with any of my defined risk strategies, is I usually let that kind of play out. Maybe with the iron condor, I'll move that, one of those legs, because then you can collect a big chunky premium for it, but for the most part, with these, I just let it play out. Okay, so let's look at the Analyze tab for this. So this is kind of that situation where I was talking about with the GDXJ. So we're risking 89 cents or $89 to make over 200, right? Because it's $3 wide. It's $3 wide. We're paying 89 cents for it. So our max profit is 200 and basically $11, right? So that is a good risk reward in my eyes, because it's over double the profit potential. So in this, if I paid 89 cents for it, I'd be looking to cover this at around $1.80 credit. If I could sell it for $1.80, that's when I'm going to look to cover that. The other side to look at is if you know, my max profit on this is $3, you know, making 70 cents on top of this, so at $1.50. So somewhere between $1.50 and $1.80 is where I'm looking to cover this. Does that make sense? Goes back to knowing your exit strategy before we enter the trade here. So that was this slide here, where I talked about, you know, either double the debit is where I'm looking to get out, or 25% of the max profit, in a sense. So the max profit on this would be the $2.10. So 25% of that is 50 some odd cents. You add the 50 in there. That's where you'd want to cover it, making 50 cents on it, or 80 cents, right? Or 90 cents, right in between there. Does that make sense for getting out? Because it's going to take a very long time for this strategy to come to max profit. You're going to be looking at inside of like 5 days or something like that to expiration before you are even close to getting your max profit. And there's always going to be some intrinsic value if it was pinned right there at the 37. So that would be a good setup. $3 wide is pretty good for, you know, 80 cents. That's a good setup there. Did I cover everybody else's Facebook? And then here I found another one. Let's just look at Qualcomm, because it was pretty close just to go with a regular stock. So let's look at Qualcomm. So with Qualcomm, what is it? So Qualcomm, we're going to be looking at, it's trading around $54. So the 55 calls are probably the closest to the at the monies in a sense here. So with that, we're going to be selling 2. And it also, Qualcomm, this is another $50 stock. Check the bid offer. It is inside of that 10-cent wide spread that we're talking about. So that fits the rule there. We can look at the implied volatility percent. It's 48. That does not, but let's pretend for argument's sake it is. We could even look at Hertz, but it's a little bit funky. I did try and look at that one earlier today. So, and Qualcomm on the chart just had earnings, has moved down. You know, it dropped on earnings, and now this is another situation where I was talking about. It's very close to this point of control is what it's called, where the most time and volume has been spent. But you can see that it's built up another volume node here, and we could easily see it just kind of bouncing back and forth and filling in this little gap here to create a nice big bell. So let's play around with this one. So we would love to get below this level here if we can. So I think that's possible. We're going to be close. So let's just look at it. So the 55s are the closest to, so we are going to sell 2 of those. Hold down the control button and then try and go, you know, the wider the better, but I think because the volatility is so low, we're not going to get that wide. So let's check out buying the 2.5s, and so 7.5s to the upside. That looks like it's off, but if you can see here, they don't, it kind of, the way the tick structure is on this one's a little funky. Sorry about that. So another situation, we're paying 68-cent debit to make $1.90. It's kind of very similar to the last one. And let's analyze that trade. Move that down to 1 lot. So we're risking 60 to make, you know, the $1.90 on that. Wait, oh, sorry, risking 70, so $1.80. And we can look at our slices here. So I don't know why that's not showing me the standard deviation. There we go. Not sure why I'm not getting one standard deviation on that. I don't have the time to play around with that. All right, so another situation, you know, the wings are kind of tight on this, but the risk reward on it's pretty good. And if we can stay within that area like we talked about on the charts, it should work out pretty good. $52 to the downside is hopefully not where it's going to go, but we'd hope it just kind of settles down. And it does have a tendency, another reason why I kind of looked at this one and let it bend my rule on the high implied volatility. After earnings, this stock really has a tendency to settle down, as you can see, into a range, and then makes its big move on the earnings and then settles down. So we can see that happening quite consistently in the past. So that's what we'd be banking on here. You know, not that past performance is any indication of future, but you know, I would be comfortable with this one kind of settling down. Is this a neutral strategy? Yes, Trevor, this is very, very neutral. Like we want it to, you know, if it were, we implemented this strategy right now at the 55 strike, we had hoped it would go right to the 55 strike there and never trade another ticker above or below it. Now, what is the probability of that happening? Very slim. That's why it's a low probability trade. We don't have the opportunity for this to move very far before we start losing money on it. So we want it to really settle down into a nice trading range like it has in the past, like this. You don't mind a move like that. That probably would have tested, in a sense, the wings on a butterfly, but you can see it comes back and kind of settles down. So what is the win-loss ratio? Is this at least 50%? Well, I would say the win-loss on this is you're going to lose, maybe 70% of the time on something like this. You're going to win about 30% of the time, but you're going to try and make it where, that's why we're going to try, and that probability is based on the fact that you're going to expiration, right? So that's why it's a low probability trade. With low probability trades, we need to take a lot less. We have to have our expectations of what we want to pull out of it a lot lower, which is why I'm only looking to take maybe 25% of the max profit on this. The wins need to be 3 times the losses in a sense, but that's why and that's based on going into expiration. Another reason why this isn't one of my favorites, but something with Qualcomm, I'm going to throw this on for Qualcomm for sure on Monday, because I think that it looks like it has a tendency to really settle down. It doesn't have a whole lot of news coming out, so I think it's going to settle down. And for the risk reward on this is pretty good. So you want me to check out BMY? When we do the broken wing butterfly, so the question is, what's a high probability trade? So broken wing butterfly is a high probability trade. The iron condor strangles are high probability trades. Short iron condor and short strangles are high probability trades. Those are some of the highest probability trades you can get. All right, and I've done webinars on those, so you can check it out at Pro Trader Strategy. So let's look at BMI. So Bristol-Myers just had earnings. Okay, that's good. They still have high implied volatility. I don't know why this didn't come up on my radar. Oh, because it just had them. So, all right, they beat so they came right in line with expectations. We can definitely look at this. All right, so let's get rid of this stuff. 21 days to go, so it's trading around $47.75. So that's probably the closest to the at the money. So we're going to sell 2 of these, and you can see it's 5 cent wide for a $50 stock. That's good bid ask. It's usually even tighter than that. So let's sell 2 of those, and then what am I doing? The 48. So let's just look at the $3. So since it has such high implied volatility, let's go $3 wide, and then $3 to the upside is the 51s. So $1.19. That's $3 wide. That's about a third of it. Let's see if we can even go a little bit, just a little bit inside of that. So we can try to do the $5.50 to get the half strikes up there. Yeah. So let's look at the 45 and a halves, and then the 50 and a halves. Go just a slightly bit tighter. So either one of those to me would work out pretty good. This one looks a little bit better possibly, even though I had to tighten it up. I mean, obviously we'd like to go a little bit wider. Let's even just for checking it out. So we were at $3 wide. Let's just go a little bit further and look at a $5 wide. So the 43s, and then to the upside that would be 53s. Is that right? Yeah. So that's $5 wide. See, we're paying over 50% of that. So you can always play around with it, get a little bit wider. So I think that first one was the one that we probably had the best shot at. So that would be selling 2 of those, and then going to the 40, what was it, the 45? I think I like that one the best. 45s, and then 3 to the upside is the 51s. Right there, about $1.19. So either one of those two, I think. The reason why I kind of picked the 45s and the 51s rather than the half strikes, I always think that they have a tendency to go for the whole strikes rather than the half strikes. They seem to, generally speaking, have more open interest in those fulls rather than the half strikes. So that's why I would probably just default in this one. Okay. So let's look at this on the Analyze tab. So we're risking $120 to make about 100 and what is that, 180? It's not the best. I guess we can check out those half strikes. So that was the $2.50 wides. 50. So oh, here, that's why that didn't work out. That one actually looks a little bit better. 90 and 60. It's pretty close. I think it's half a dozen to 1. Which would be better strategy, the iron condor or the iron or the butterfly call, which are expected price to go sideways in the range. If you were pretty confident on it trading tight, this strategy is going to pay out better than the iron condor. You're not going to collect nearly as much. The iron condor has a higher probability of success, so it's kind of like you have to weigh those options. But the iron condor, you're not going to be able to collect as much, and therefore your trade-off is you aren't going to collect as much, but you have higher probability of success. This has lower probability of success, but a higher payout. So you kind of have to weigh what you think is going to happen with that. Does that make sense? What percent of the width would you like to pay for the butterfly? That's a great question. So, we could look at it like this, the $2.50, I think the best wheelhouse is somewhere between 60 and 80. So what percentage is that? So 250 divided by 80, is that the right way to set that up? No. Let's say 80 divided by the 250, what percent? So it's like 32% would be the best case scenario. What about a ratio butterfly for this? Yeah, we're going to be doing, well, broken, Rick, I'd probably lean towards a broken wing if you were really worried about directionality on something like this. Yeah, so it's about the third, you're right. What was the other one? Please help me understand the debit and credit sides. If I open a trade with a debit, then do I close the trade for a higher? No, well, it would set it up as a credit. It would say you're collecting a credit. But you are selling it for, you're selling it for a credit because you're getting out of it. If you're right. The green and red colors are sometimes confusing. What they try, especially when they give you the negative, sometimes they give you the negative, which makes it even more confusing. So that's the other thing. But the green is usually it's indicating you're paying a debit, and when it's all red, it means that you're collecting a credit. Sometimes it does get a little funky where sometimes it'll look like you're doing a negative credit, which means you're doing actually a debit. But not to get too confusing. Usually the green means you're doing it as a debit. Usually the red means you're collecting a credit, just so you guys know. So I'm going to be probably looking at that Qualcomm trade on Monday. So if you guys are following me on Twitter, I will likely be talking about that trade in the daily market commentaries. So hopefully you guys are watching those, because I basically go over all of the trades I do, with they're winning or they're losing, you know, when I take them off. Just like in the Adobe trade, I did it for the short put butterfly. I just took it off because it got that big move that we wanted. It wasn't quite as much as, you know, fitting the rules, but because that it made that move so fast, and right after I put it on, I had to take that trade off just for the profit. So, you know, I beat the probabilities and I decided to take it off. What kind of stocks are good for the butterflies? Anything that is, you know, likes to trade in a range, and you get into it with high volatility, like, you know, BristolMyers. Actually, I might even look at BristolMyers again. As a matter of fact, I'm going to put that on a note in my notes to look at BristolMyers on Monday too, because it should fit those rules. But anything that looks like after earnings has a tendency to settle down. I think the Qualcomm looks like it has a tendency to settle down. This has a tendency after earnings, if they were bad, has a tendency to continue down. After the earnings were good, as they're kind of settled down, but here it continued to rally up. So I might lean towards the Qualcomm, because just from past history, it seems to settle down right now afterwards. Does one have the to be a member of Pro Trader Strategies to follow you on your daily market commentary? Yeah, that's part of that goes with any of the classes or offers we do. It comes along with that. Does that make sense? Okay. What's the difference between the call fly and the put butterfly? How do you know when to use either? Great question, Luke. They're pretty much interchangeable at the end of the day. You're going to look at the Analyze tab, and they're going to look very similar. So they're pretty interchangeable. One of the nice thing is, and I'll talk about that next week, you have a tendency to get better pricing with the put butterfly than the call butterfly. So we'll talk about that next week too. We'll talk about all of that stuff. Would I use this trade after earnings? If the volatility was still above 50 right after earnings, I definitely would look at it. It's really hard to catch that, but it probably would have worked pretty good with like Google today, as in the morning the implied volatility was still a little bit high in there and came off throughout the day. So you could, and it settled into a range for the better part of the day. So it could happen where that works out very well. I'm usually covering trades at that point. So for the Adobe trade, you opened the trade with a debit, say, of 85 cents, and you closed the trade with a debit of greater than 85 cents. Well, it would have been a credit. The Adobe trade I had on was the Feb 100, 110, 120 put butterfly, and I originally did it for a credit of $6 and I think it was 30 cents, and I closed it for a debit of $5.53. So if you sell as a credit first and buy as a debit, you want that to be lower, and if you buy as a debit, then you want to sell it as a credit higher. Does that make sense? So in this case, for this strategy, if I paid 87 cents for it and I wanted to make twice as much as what I paid as a debit, I would look to sell this for, what is that? Let's say somewhere around $1.74. Is that right? Just off the top of my head, $1.74, because I would double that credit. So I'd sell it as a credit of $1.74. $1.74. Does that make sense? So I paid a debit at 87 cents. I'm looking to double what I paid as a debit. So I'd sell it as 87 plus 87 is $1.74. So that's where I would sell it as a credit. See, it goes to a credit and it's red. So I would look to sell it at, please don't mind the chart flipped, of course. But, so we're trying to sell it up there. Don't look at this, but down here. See, we paid a debit, and then when we cancel out, you're selling the opposite to get out. Okay? That makes sense for everybody? Great. All right, so hey, we're doing floor trader hacks. This is stuff that I learned on the floor, you guys. This is ultimate time savers on a lot of what I talk about this in here. A lot of math goes into finding out option strategies, what makes sense, probabilities. If you guys listen to me, I'm always talking about probabilities of success. And I go through with these videos here and talk about shortcuts we used to use on the floor, because time is of the essence, right? I mean, if you're spending all this time like punching stuff into a calculator and trying to figure out different things, it takes a lot of time and you're missing opportunities out there. I talk about how to streamline that process, and also with these hacks, it kind of puts it in your head where you can just look at several different things in those option montages quickly and discern probabilities and know where the earnings are without even going up and looking at looking it up on Morningstar. I can even show you different ways. I even show you different ways, I should say, of figuring out what the dividends are going to be even before they announce how much that dividend is. I show you how to figure that whole thing out. Would a drop in the IV hurt or help us with this trade? A drop in the IV is going to help us. We want that drop in IV. That will definitely help you, because then the premiums come out of those near term ones. So it will help us, the premiums will come out of those. The extrinsic value will come out of the calls that we sold, and the ones that are at the money hold a little bit more volatility more than the ones that are the wings. So a drop in volatility will make those decay faster, further away from at the money, and those at the money ones will hold a little bit more value, so that will help us. Does that make sense? And I talk about some of that stuff in these videos. So, that's why it's really important. Go through these videos and watch them a couple of times, because it will really make you learn them. And if you want to trade like a professional trader, like I always say, the best traders were the guys that were on the floor. They're not the guys that are on Twitter that only talk about their winners. If you follow somebody and all they ever do is talk about their winners, you need to walk away from that, because that is not real life. And I don't know if they're just cherry picking the good ones and telling you the ones that they always win on to try and boost their own ego. But I'm probably the complete opposite of that. When I'm talking on these daily market commentaries, I probably talk more about my losers than I do my winners, because the winners, they come and go quickly. I don't even remember good winners, but I remember those losers that I managed, I stay mechanical with, and I turn them from losers into at least a scratch, and many times winners. So I talk about how to manage those losers and talk about those losers all the time, because those are the ones that drive us all nuts. Those are the ones we spend most of our time thinking about. So, and that's what floor traders do. Floor traders talk about their losers more than their winners, because they want to learn from it. You don't learn a whole lot from winning trades, and you do learn a lot from those losers. But these floor trader hacks videos, I talk about all the different ways you can figure probabilities out from delta, and just quick ways that will save you hours in a day probably without doing the math. And shortcuts. They're all shortcuts. So this is a great course to really learn, because it's what we use daily on the floor, and it's designed to help you create consistent winners by doing that. You know, when you know the probabilities and do that, it will help. I mean, this for $500, it's a low price, and earnings season is here. That's going to probably help you out in earnings season and pay for itself, you know, in the next couple of weeks already. Just trying to figure out where you need to place your bid and offers and how to get in and out of these things, and what are the right things to look at before trading the options. All right. So this link is in the chat window there. It's not in the window that we're talking back and forth here. It's in the chat window, so you can easily click on that. It is well worth the money, you guys. I mean, it will turn a light bulb on when you start seeing this, rather than trying to punch everything into a calculator. Right? So use that link there in the trade window. And the other thing is, this is the wrong link. So let me try and change this, put this in there. You're not going to let me link it. But basically it is / Wolfman trading options - volatility. That I think is even the wrong one up there. This is the Trader Hacks video. Let me find that real quick. Let me get this. Okay, that does look like it's the right link in there, actually. So mine just did the shortened one for it. So use that link though on the side there. So yeah, there they got it. They put it in there now. So I think the other one was the opposite one. So it's in there right now. It's the second link that you can use for it, which is this one right here. Oops. Here is the link for the course right here. It'll bring you to this window, Floor Trader Hacks for Options. So that's the link. You can do www.protraderstrategies.com / floor-trader-hacks-4-options. All right. So you can go to that link right there. It's really easy. And you get all of those different videos. Also, if you have any questions, call us at 310-598-6677 or email us at trading@protraderstrategies.com. All right. Thank you, guys. Appreciate it. And have a great weekend. Like I said, here is that link right here. Can't really copy and paste it, but you can pause the video and type it into your URL. All right, guys, I hope you guys took something away. And, you know, if you took anything at all away from this, and learned something new from a strategy that everybody talks about, you know, I can guarantee you, you're going to learn a lot from this video here. So you should really take advantage of it. All right, guys, have a great weekend. If you can't take that, take it easy.